Hey, what's going on, guys? Today I want to talk about in terms of the concept of riding the yield curve, right? Riding the yield curve is also called as rolling down the yield curve. I'm going to explain why that's what it's called. It's an interesting concept. So that's the topic you'll be talking about. So it's either called as riding the yield curve, same thing as called rolling down the yield curve. Now let's get into it. Now the key assumptions on this one, if you really want to understand the yield curve, is that interest rates are upward sloping, right? Which is regularly a normal yield curve. So you have this chart on here where this is time, and let's say these are the rates. Then if this is a 1 year, maybe you'll get a 1% rate. If you have 3 years, you might be getting 3%, right? Or if you have, say, 10 years, maybe you're getting 10%. So which means when time increases, the rate also increases. I mean, that's kind of natural to know, right? If you have in terms of, if you have a 1 year rate, it's kind of easy to tell, hey, you know what the rate is going to be 1 year out. So I mean, you don't really need to be compensated that much. But in terms of 10 years rate, can you really tell what the rate is going to be 10 years? Because now in terms of the rate, it's going to be depending on how the economy is doing and so on, right? I mean, you can't really go and predict what the economy is going to do 10 years from now. 1 year from now, sure, you know what, you can tell. So the higher uncertainty, you'll also have to factor into if there's high uncertainty, then of course you need to provide an investor with more returns. So that's why you get upward yield curve. The second assumption is that the interest rates, whatever assumption that you have done, is interest rates do not change, which means if we assume that the rate is 1 year is 1%, 3 years 3%, 10 years is 10%, these do not change. So these are the major two assumptions in terms of writing the yield curve. Now the concept in this one is, let's say let's draw out the rates over here. Let's say 1%, 3 is 3%, and 10 is 10%. Right. Now the theory really is, let's say if there's an investor, right, and his time frame is 3 years. Now what can he do? He can either go and buy, if he wants to immunize himself, which is don't get affected by, he doesn't want to get affected by interest rates. If his time frame is 3 years, maybe he's going to retire in 3 years, and therefore he wants to use this money in 3 years time, or maybe he wants to buy a car. Whatever the reason is, his time frame is 3 years. At the end of 3 years, he wants his money back, right? So he's into 3 years. So if you want to do immunization, which means if his time frame is 3 years, he's going to go and buy a 3-year bond. And based on example, a 3-year bond is giving us 3%, right? Now the question really comes down to is, can he make more money, right? So can he make more than 3%? The idea is yes. Now I'll show you why. So let's say, you know what, let's assume that instead of buying a 3-year bond paying 3%, he actually goes and buys a 10-year bond, right? He goes and buys a 10-year bond which pays him 10%. Right? Is that possible? Sure, that's possible, right? Now what's going to happen? I mean, when you bought a 10-year bond, it doesn't mean that he has to hold it for 10 years. I mean, at the end of 3 years, if that's what it is, then he can go and sell it. Now what happens after your, let's say we are 3 years in, so when you talk about the rolling down the yield curve, we are going down this way, because over time, when you bought a 10-year bond right now, his 10 years is left. What happens if there is 7 years from now, right? 7 years from now, we are sitting over here. 10 years from now, you're sitting over here. Now you're sitting over here. So now we're writing down the yield curve. So we know that, you know what, 7 years from now, there's time remaining is 3 years, and we know the 3 years is giving you 3%, right? So think about it this way. What do we know about bonds, right? If interest rates goes down, then bond prices goes up, right? So what is affecting, what's really going on in this writing the yield curve is not only is he can go and buy a 10% bond where he can make more returns, he can potentially also make capital gains, because I mean, if the interest rates at this point of time, if interest rates is 3%, which means let me do another one. So let's say, you know what, so 1, 3 and 10, right? 1, 3 and say 10. Now these are the rates, right? And this is time. Now we know that if with a decrease in rates, the discount factor is actually going to go up, right? Or the present value of the money is going to go up, because we know if interest rates goes up, or in this situation interest rates goes down, the bond value goes up, right? So interest rates goes down, so let's say, you know what, at this point of time, maybe this was being priced at say $100, or let's say $1,000. By the time it's only 3 years left, maybe at this point of time, maybe it's now trading at $1,300, or now it's 1% left, maybe it's now trading at $1,500, right? This is really the theory. If interest rates goes down, the bond value goes up. So if interest rates goes down, the bond value is actually going up, right? The interest rate is going down from 10 to 1, the bond value is going up from 1,000 to 1,500. Now going back to the question on here, in terms of not only is he going to make more return, right? So in this point of time, he's making an interest rate of 10% for the 3 years he's holding it, or for the 7 years for the 3 years he's holding it. If he were to, you know what, hold it, then you know what, there's also a gain. There's going to be a capital gain appreciation, right? So that's in terms of, so that's a strategy of really riding the yield curve, where if your time frame is 3 years, you don't really buy the bond for 3 years. What you actually go and end up buying is something which is longer, so you're compensated for higher interest rate. You're also getting compensated based on the yield curve, because the yield curve is you're going down, right? In terms of how much time left, you're going down, so you also have a capital appreciation. So that's a concept in terms of writing the yield curve.